So far in our course we've done a lot of work on the balance sheet. What we need to do now is move on to another report which covers profit. And the first thing we want to do is look at, well, there's actually three different types of profit that we're going to need to calculate. So, as well as the balance sheet, we're now going to prepare a statement called the income statement. And that is a report that shows the revenues earned minus the expenses incurred in order to determine the net profit for this period. And here's the sections that we're going to have. We're going to have revenues, and this is the order in which we'll do them. So at the top we'll have revenues, and that'll be our sales of inventory to customers, and we can break those into cash sales and credit sales. We'll minus away any sales returns, so inventory returned by customers for a credit, and that will give us something called net sales, which is just revenues minus sales returns. What we'll do then is go minus cost of goods sold. Now we haven't really dealt with that term. What does that mean? It looks like something we've dealt with called cost of sales, but it says cost of sales there. That's actually a different thing, and we'll look at that in the next video. But for now, we'll just say there's a section called cost of goods sold, and that'll be all costs or expenses incurred in getting inventory into a condition and location ready for sale, e.g. cost of sales and delivery in. That will equal gross profit, the profit made from buying and selling an inventory. And then we'll plus or minus inventory gain, loss, or write down. We haven't done write down yet, but we've done inventory gain or loss. And that will give us something called adjusted gross profit, which will just be our gross profit plus or minus any inventory gain, loss, or write down. And finally, we'll take away our other expenses, which are incurred in running the business day to day, and that will give us net profit, the final profit made by the business. So what we'll do in the next video is actually go through what's the difference between cost of goods sold, cost of sales, and other expenses. But for now, we just want to note that there's actually three kinds of profit there. There was gross profit, adjusted gross profit, and net profit. So what are they? Well, let's just take it from the sort of very beginning and go, we're doing trading firms which buy and sell inventory, all right? So here's the suppliers, here's our business, and here's the inventory. We buy that for one price, and let's say in this case that's $60,000. We're going to call all the expenses incurred to bring inventory into a condition or location ready for sale something called cost of goods sold. And we'll look at this in more detail later, but for now the things that'll be in there are cost of sales, delivery in, so delivery to get the inventory to our business, packaging, buying expenses, customs duties, things like that. So we get all the inventory into our business, and let's say that all costs $60,000, all of this, and then we want to sell it for more than that. That's how we make a profit, and that would be $90,000 there. So let's say all this inventory cost us $60,000 by the time you add up all this. We sell it for $90,000. So in our income statement, that will be our gross profit. We'll have revenues, $90,000, less cost of goods sold, which in this case we'll just make up some numbers and say it was cost of sales $50,000 and delivery inwards of $10,000. That was a total of $60,000, which is here. And that will be our gross profit. And that is the profit made from buying and selling inventory. We bought it, cost $60,000, we sold it for $90,000, and we made a gross profit of $30,000. But unfortunately, we don't get to keep all that as the business. What we've got to do is take out and add in some other things. So as well as buying the inventory to sell it, there are other revenues and expenses that will occur in managing the inventory. And we've dealt with those. We've dealt with inventory gain, a revenue earned when the inventory count shows more inventory on hand that is shown in the inventory card. So we add that in. But we also have to take away inventory loss, an expense incurred when the inventory count shows less inventory on hand that is shown in the inventory cards. We'll also have something called inventory write-down. I'm not going to talk about that now because that will be in a couple of lessons time. So we'll just say that will go in there when we do get to it. And what we'll do is we'll add all that up, and you can see there's a gain of $3,000 and two losses of $1,000. So that equals a net result of $1,000, and that will give us adjusted gross profit. So the gross profit plus minus inventory gain, loss, and write down. But again, unfortunately for the business, we don't get to keep all of the adjusted gross profit either because we've got to take out some other expenses, and we call these literally other expenses. These will be incurred in running the business day to day. So we had some expenses up here in cost of goods sold, but we're saying there's other things like rent, wages, insurance, marketing, and a million other things. And what we'll do is we'll put them under other expenses. So in this case, we've got rent and wages. And if we total that up, what we do now is take our adjusted gross profit of $31,000, take out our other expenses, and that will give us our net profit. And that is our final profit. So in the business world, net just kind of means final. Gross is a weird word to use, but in business you might see it a lot. You also might see it with your wages. Gross means before other things have been taken out. Yeah, so gross profit is not final profit. Net profit is final profit, which in this case is 20,000. So just to summarize all that, we're going to do a report called the income statement. It'll look like this. It'll have some other sections that we'll add in, and it will have three types of profit. It will show the gross profit, the profit made from buying and selling inventory. It will show the adjusted gross profit, which is the profit made from managing inventory. So that includes gross profit plus or minus these items. And finally, we'll take out the other expenses, and that will give us net profit, which will be the final profit made from running the business.